Hey there, welcome to the Open right here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Canada's Financial Consumer Agency says it has fined the Bank of Montreal $4 million for overcharging customers. That's after the bank failed to properly disclose fee details. According to the watchdog, more than 100,000 customers were affected between 2010 and 2024, and the bank has issued refunds totaling more than $3 million. The penalties relate to discounted bank accounts for newcomers, medical and dental students, and Indigenous clients. Shares in PayPal plummeting in the pre-market. This comes as the fintech company and payments giant says Chief Executive Officer Alex Chriss will be replaced by HP CEO Enrique Lores due to the firm's profit and revenue falling short of expectations. PayPal highlighted weakness in U.S. retail spending and headwinds internationally. The payment firm's chief financial officer will serve as interim CEO until Lores takes over on March 1st. Canadian Pacific Kansas City says it set a new record for shipping Canadian grain and grain products last month, both by amount and carload. The Calgary-based company says an effective crop year, winter planning, and demand forecasting helped prepare the railway. Last week, the carrier also reached a record high in fourth quarter grain revenue, driven by a bumper crop. It looks like we're going to get a slightly higher open for U.S. stocks today, holding above 7,000. Investors inspired by strong results from Palantir, the software giant. Let's check in on oil. And it is, the TSX Composite first. And the TSX Composite it rose yesterday, and we did see something of a rebound in gold this morning. So that could support our market as well. Let's check in on crude oil. Always a dear subject to the heart of Canadian investors. And oil, of course, has been helped over the past year, or given some support by a weaker U.S. dollar. I think that chart is giving us a bit of trouble. Maybe we'll move on to gold. Let's see how gold is doing this morning. And gold, something of a rebound, but of course way down from the 5,500 level that we saw last week when gold blasted to record highs. And let's have a look at our dollar, the Canadian dollar. And it's holding there above 73 cents US. And finally, Bitcoin. Let's see how that giant crypto is doing. It has been having a rough few months. Look at that. Looks like it's dropped to a 52-week low today. It's certainly close to that, and down almost 20% in the past 12 months. As just mentioned, shares in Palantir have been climbing in the pre-market. That software vendor beat fourth quarter estimates on the strength of its AI and defense businesses. Let's get more from Michelle Connell, president of Porsche Capital Management. Thank you very much indeed for joining us. Palantir, of course, is in some ways a poster child for the high-flying tech stocks over the past couple of years.
Good morning, Andrew. Thank you for having me. And you're dead on correct in terms of Palantir being a darling, especially for high-flying tech. But they didn't disappoint this time. They took up their estimates that this year in 2026, revenues should be up, according to them, 61%. U.S. revenues up 100%. There just continues to be a high demand for their software platform that combines AI with decision making, and that's their competitive moat.
Comment, would you be a buyer of Palantir now, or has the stock, maybe we'll put up a 5-year chart, is the stock too rich?
I think it's a little bit rich for me because even though my background is semiconductors and tech stocks, you look at the forward PE on this and it's about 145 times earnings. Whoa. And compare that to NVIDIA, which is only 25 forward earnings. So it's pretty rich here. And in the last year, I believe with today up about 80% or more. So it's pretty rich here, but does the company warrant it because they do have that competitive moat that I spoke of? Maybe, but I would not be a buyer here because I see that, I always look at things in terms of upside versus downside, and I don't see a real good trade-off there.
Commenting on earnings overall, you reckon that tech and industrials have been strong sectors so far?
Yes, they definitely have. But it's those tech companies that are delivering, right? So you look at the difference between Microsoft and Meta, they're both putting so much money into capital infrastructure for AI. Meta is able to deliver on the revenues behind that. Microsoft is not. So you have to be very selective about what you're buying, and that companies can continue to, if they have a big capital spend, that they are going to be able to deliver on the earnings and on the revenue side.
You have some stock ideas for us, and you've been following semiconductors for quite a while. Taiwan Semi, what attracts you to that name, Michelle, right now?
They are the #1 fabrication facility in the world. Intel is like the stepchild that is trying to catch up #2, and they just can't do it. And Taiwan is able to continue to build out their fabrication facilities, and the demand just keeps roaring behind it. They cannot keep up with that demand, at least at this point, no matter how much they're spending on building those fabrication facilities. So their revenue and their earnings are expected to be up over 30% this year, and they keep increasing their earnings. So I think it has some upside here, at least probably in the next 12 to 18 months.
Another tech name that you favor is Broadcom, and of course they are seen by some as an AI play.
They definitely are an AI play. That's what the market has been rewarding them for anyway. About 50% of their revenues at this point come from AI chips. The difference with Broadcom versus NVIDIA is more of a general or a GPU chip play for artificial intelligence. Broadcom helps deliver a customized AI chip for their clients. So they're able to build out the needs that a company may have specifically for their own environment. And that is why I like this particular name.
And then finally, Okta, O-K-T-A on the NASDAQ. Remind us what they do, please.
There are a software play that delivers artificial intelligence or AI agents, and they provide a complete platform that can help a company build out an AI agent platform. And they have not been rewarded well in the last year, as you can see from the chart. It's starting to get some interest here as they're signing up more customers. I think last year they signed up about 200 more clients for that AI platform that they're able to deliver. I do need to say that is not their only product, but what tells me that there might be some more value to the stock, Andrew, is that the company announced a big buyback at the beginning of January.
And and that seems like a reasonable use of the cash.
Yes, it does. And they have enough cash, too, that they'll continue making acquisitions and tucking them in, which the company has been very adept at doing. They've got strong management.
Michelle, thank you very much indeed for joining us this morning.
Thank you, Andrew.
Michelle Connell, President of Porsche Capital Management. Coming up, Veritas is out with a list of its favorite dividend stocks and some that they think you should be cautious about. We'll be back after this. Veritas Investment Research is out with a report that looks at some of Canada's giant dividend-paying stocks, and it isolates those it thinks are poised for robust dividend growth and those you may be you should be cautious about. Let's get more from Dan Fong, Vice President and Head of Research at Veritas Investment Research. Dan, thank you very much indeed for joining us.
Thanks for having me, Andrew.
I know it's hard to generalize. They're very diversified stocks, but you say that you're looking for stocks with what you call a meaningful yield in general of more than 3% here.
Yeah, that's right. We find that most dividend investors, we're looking for companies that offer some attractive yield. Anywhere under that 3% range isn't necessarily that meaningful unless you see prospects for further dividend growth or total shareholder return, buybacks, and that sort of thing. But generally speaking, that's kind of the wheelhouse that we look in, and that's the wheelhouse that our clients look at.
Let's get to some of these names that you think are attractive. And there's quite a few here, but we'll start off with Cogeco, if we could, a yield of, and there are the names, ATCO, a diversified provider of buildings and stuff, among other businesses in Western Canada, Granite REIT, Cogeco, CIBC, and Alimentation. Can we start off here with Cogeco? And I'm sorry, I forgot to check. Do you mean Cogeco Communications or Cogeco Inc.?
Communications.
Sure. And what attracts you there to that name?
Well, so our analysts will be able to speak to it much more fluently than I could. But however, from a higher level, what we see here is a reasonable dividend payout ratio. So they're well within that. Debt metrics seemed on par, and they're operating the business quite well from our standpoint. So we're pretty comfortable in terms of the sustainability of that dividend, and as they grow their business, as they continue to execute on their strategies and their capital allocation strategies, we think this is a solid dividend play.
Right. And then dividend lately about 5.5%. CIBC stock has been hitting record highs, dividend yield of 3.3%. That's one of your favorite names. And of course, the banks are they're stalwarts when it comes. I mean, they have a shareholder base that expects regular dividend increases.
Yeah, that's right. And if we look across the entire banking universe, or at least the Canadian banking universe, what we find there is their capital ratios are very, very healthy. So they've got a lot of capital buffer. Each of the banks will have their own specific growth strategies, either U.S. expansion or wealth management and that sort of thing. But having that capital buffer affords them a lot more flexibility in terms of capital allocation. Some of the capital allocation will be reinvested in the business, as I just mentioned, but it's going to leave a fair amount of room for shareholder returns, things like share buybacks and dividend increases. So we see that happening across the board here. I will note, though, that at this point, the Canadian banking space seems to be trading at near peakish multiples for a period where we're entering into some economic volatility, economic uncertainty. But that being said, we think those capital buffers will be very defensive when they need to be, but also they'll be able to deploy that capital in a shareholder-friendly manner.
A name that jumped out first was Alimentation Couche-Tard. The dividend yield, relatively low, only 1.2%, but they've been increasing it steadily for almost 2 decades.
Yeah, that's right. So it's a pretty steady dividend grower. And the interesting thing about Couche-Tard is after last summer's failed attempt at the 7-Eleven acquisition, they've pulled back on that. They've got a fair amount of balance sheet capacity to go out and resume their tuck-in acquisition strategy. They've also renewed a share buyback program. And, because they're not necessarily going to swallow up a large giant like 7-Eleven, it affords them, again, more capital allocation flexibility for shareholder returns.
And then among REITs, Granite, you think offers a decent balance sheet and pretty strong prospects for distribution growth.
Yeah, and the balance sheet is really key for that one. That's probably got the best balance sheet, best of class balance sheet, best operating company in that space. Very comfortable with how they operate that business and with that dividend payout ratio. And as they continue moving along, we do see great prospects there.
If we could move on to these are dividend names that you said people should be cautious about, and you stress that you're not in any way forecasting a dividend cut here. But start off with Brookfield Renewable, yield lately about 5.3%. It wouldn't be among your favorite dividend stocks.
No, that's right. And we have a two-person team here that digs into the entire Brookfield complex, Brookfield Renewable being one of those. And what we find at Brookfield Renewable is when we look at that payout ratio, it is extremely elevated. But more than that, when we look at the sustainability of those distributions, a fair amount of that is tied to what's called capital recycling, buying and selling some of their assets. And when we strip out the gains from that and look at an organic cash flow per unit type growth, that cash flow per unit growth is fairly minimal. It's in that 2% type range. So it is very difficult to sustain a 5 or 6% payout or 5 or 6% yield when your unit cash flow is only growing at 2%. So what this means is, the bet here is more on capital recycling, debt issuance, equity issuance to sustain that distribution.
Just looking at, we're tight for time. I could talk to you about dividend stocks all day. They're so fascinating. I mean, it's been such a great, reliable source of returns over the years. Emera, the electric utility, yield lately about 4.3%. Again, not a dividend stock that jumps out for you in terms of your favorites.
Yeah, again, elevated dividend payout ratio. But more than that, we look at their balance sheet, and they have elevated leverage. And based on our analysts' assessment, what it looks like is in order to sustain their target debt ratio metrics, they may have to resort to additional equity issuance. Typically, when you're relying on equity issuance to fund your debt, that's not necessarily a recipe for dividend growth. And in fact, if we see things turn the other way, then yeah, we would see some risk there.
Dan, thank you very much indeed. Really appreciate it.
Great. Thanks for having me, Andrew. Dan
Fong, Vice President and Head of Research at Veritas Investment Research. We'll be right back. The Port of Churchill in Manitoba is located on Hudson Bay, and it's North America's only deep-water Arctic seaport with direct rail access. Of course, it sounds attractive as Canada seeks new export gateways, but that port's future is not set in stone. CTV's Alison Bamford reports.
Those who've lived in Churchill, Manitoba long enough remember the days of a bustling port.
Churchill and the port are pretty synonymous with each other.
Joe Stover worked there for 10 years at the tail end of its glory days.
That was going to be my retirement job.
The port currently operates just 4 months of the year. Ottawa has flagged it as a transformative project known as the Port of Churchill Plus. The project would upgrade it to a year-round multi-commodity hub, connecting Western Canada to the north and the Atlantic through Hudson Bay.
It would mean everything. It would mean everything to get people back to work and have an opportunity for our youth to stay here if they choose and make their living here.
Since the port slowed, tourism has become the main economic driver.
In a given year, we have upwards of 25,000 visitors that come to Churchill.
They're flocking to the polar bear capital of the world for the wildlife and the northern lights. The Chamber of Commerce says any port upgrades would have to strike a balance with the tourism industry.
Churchill has a lot of land-based research. I've had it for many years, and we're also gaining water-based research. And so right now is a great time to put that all together.
Manitoba's premier is set to visit the remote community tomorrow to hear what residents have to say about the port's future, which for right now is still not set in stone. But community leaders say it's time to act.
Diversification is critical, it's key. We can't succeed on just tourism.
Manitoba's premier will touch down on the frozen tundra tomorrow. On the agenda, talking tourism, marine conservation, and a town hall with residents before he plans to play some hockey with the locals. Alison Bamford, CTV News, Churchill.
Okay, yesterday on Market Call, let's get a recap. Oh, yeah, there we have it. It was Barry Schwartz, one of our favorites. and he was talking about giant North American stocks. Microsoft was among his favorites, MSCI, and Lincoln National. Today on Market Call, it's Tim Regan, and he's Managing Director at King West & Company. North American large caps are on his menu as well. Let's check out the U.S. futures as we head towards the opening bells, and it looks like the S&P will open in record territory. It has never closed above 7,000 before. Its record close was on January 27th at 6,978, but it is poised to open above 7,000. And let's have a look at how the TSX traded yesterday. It rebounded from Friday's ugly selling yesterday. And the record for our domestic index was set on Wednesday of last week at 33,176. So it looks like our market, the TSX, is poised to open in record territory as well. And let's check out Asian stocks to see how they are trading today. Quite the gain you can see the Nikkei shooting up around 4%. That market in turmoil, though, with the return apparently of mild inflation to Japan and a pretty steady rise in bond yields. Nevertheless, despite that increase in borrowing costs, Japanese stocks up around 9% so far this year. And in fact, the Nikkei hitting a fresh record high. The tech sector and finance sector in that country doing well. Let's have a quick look at TRI, Thomson Reuters, in the pre-market. Of course, that's a blue chip company, to put it mildly, the Thomson family among the world's global elite. That stock down sharply in the pre-market, along with a bunch of companies that provide professional analytics. Experian. It's interesting. London Stock Exchange down as well, big provider of financial data. Why is that? Apparently Anthropic, the AI player, has released a tool designed to automate legal work. It can automate work like contract reviewing and legal briefings, and it is seen as a sign of competition in the legal space. That's fascinating. I mean, big, elaborate contracts. I don't know how lawyers do it. They need to be detail-oriented. Certainly some of this is going to be automated. Fascinating. I guess we should watch the TSX today. They are a big data vendor, but we'll check them, TMX Group, at the open today. Those opening bells are coming your way next. Okay, opening bell to the NASDAQ. Pharvaris is doing the opening bell. That's a biotech company. At the NYSE, it's Oracle. And at the TSX, Middlefields, the investment manager, doing the honors. It's time for the first 15. And let's check in on those benchmarks to see, are we at new record highs? And the S&P not quite above that 7,000 mark, but certainly in record territory. We also have our market, the TSX, pushing higher. So the S&P just a little bit down from last week's record high. Let me just check very quickly on the TSX, almost 32,500, but still down from its record high on Wednesday of last week, north of 33,000. But certainly stocks moving up in early trading. Few stocks that are on our radar. Let's have a look at Thomson Reuters, TRI. As I mentioned, Anthropic has come out with software or AI, an AI tool designed to automate contract evaluation, a lot of the work that lawyers do, and apparently that has spilled over into other data analytics companies. We did see London Stock Exchange Group, which is a big data provider, dropping as well. Let's just have a look at TMX Group. The only reason I mention that is if we see London Stock Exchange down, Maybe X is getting some selling, but no real reaction in that stock. And let's have a look at Bombardier, which has been caught up in trade tensions with U.S. President Donald Trump threatening to bar Canadian aircraft if Canada doesn't get its skates on and certify Gulfstream aircraft. And the FAA, the U.S. regulator, certainly so far backing Trump's attacks on Canada over delayed Canadian registration. And Bombardier holding its own today. And finally, GDI. Now, this is a big provider of janitorial services, and it's subject to a take private bid. But now two major shareholders in GDI Integrated saying they are going to reject this take private offer from Birch Hill Equity Partners and the company's top executive. The offer is $36.60 a share. But an investment manager called Medici and now also Montrusco Bolton Investments say that's too low. It's unfair to shareholders. Let's get some stocks on the move south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, thanks very much indeed for joining us. Palantir, they always seem slightly sinister to me with their work for defense and intelligence. Somebody has to do it. Anyway, investors liked the numbers from this company.
Investors like the numbers from this company a lot. The revenue for the fourth quarter really beat expectations, and by quite a wide margin. The earnings outlook for this company was also well ahead of where the street expectations were on Wall Street. Just to give you a sense, Wall Street had expected revenue of $7.18 to $7.22 billion over the next year. Sorry, that's where the company sees its revenue. Wall Street's expectations were $1 billion lower than that at $6.2 billion. Adjusted profit, same thing. $4.1 billion is where the company sees itself going. Wall Street's expectations were, again, $1 billion lower than that. So this company has kind of come out and blown the doors off this morning in terms of the expectations for the year, as well as beating on profit for the fourth quarter. And so what they've gotten is they've gotten a handful of price target boosts and upgrades, including at Baird this morning. Baird came out and said that the revenue and cash flow was, quote, too impressive, which I'm sure Palantir will take to the bank. Okay. Too impressive.
Of course, this company has a legendary price-to-earnings ratio. Right now, the estimated PE is about 130 times for this calendar year. But of course, people aren't looking.
And they've also had a lot of pressure as well recently, including Michael Burry, who is the one of the short sellers from Big Short fame, has bet against them previously. So they did, they did really need a bit of a blowout quarter, which looks like they've got now.
Okay, Palantir. PayPal is saying goodbye to its CEO.
PayPal is saying goodbye to its CEO, and the stock is getting hit as a result this morning, not just as a result of the change in the CEO. They are bringing in a new one from HP. The board came out and said that the rate of change and the turnaround plan that was being executed under the previous CEO was not fast enough and did not bring out enough results. I suppose the company is the worst performing stock in the S&P 500 so far this morning. Yeah, yikes, down 17%.
Wow.
Results were worse than expectations. Earnings per share, revenue well below, and the guidance was well below estimates. A number of analysts on Wall Street were out this morning saying that this company missed what was already low expectations. And so that is what we're seeing with the shares today, getting hit really hard so far this morning.
Jeff, thank you very much indeed. That's Jeff Morgan of Bloomberg. Coming up, we'll drill into the question of whether the S&P 500 has more room to run this year. Okay, so we've had a choppy market over the past week, but our guest says we do have what looks like a dovish-leaning Fed, and we still got a lot of AI euphoria in the market. He reckons that stocks look poised to extend the bull market for yet another year, We're joined by Andrew Slimman, Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, great to see you. Thank you very much indeed.
Hey, Andy, how are you?
Very good. So far, the U.S. economy ticking over. I know people say, well, look at the debt, the deficit, and corporate earnings holding in. So those two factors point to more gains for stocks, presumably.
Sure. Yeah, I mean, look, there's positive and negative. The positives are, the speed with which the Fed cuts under the new Fed chairman, is to question, but they are in a cutting regime. We are going to get tax cuts here coming starting this month. That is, that's positive. Mm-hmm. Earnings are coming through. That's certainly positives as well. And, the consumer is kind of morose. And actually, when consumer is morose, the rate of change can improve, and that's a positive sign. The negatives, though, Andy, is the market's up a lot, and naturally there are a lot more optimists about the market today than there was 2 years ago when the opportunities were better. And this is an important point, when you have high expectations of GDP growth and high expectations of earnings growth, the stock market tends not to do as well as when there is low expectations. And that's a quadrant we find ourselves in. So I think it'll be an okay year. But, we're getting later cycle and there's more dangers out there.
Give us that again. When there's high expectations of earnings growth, the market.
And high expectations of GDP growth, it's the lowest returning quadrant for the stock market.
Why is that? Because obviously people have done their perhaps investors have already done their buying.
Exactly, Andy. So when expectations are high, that's a danger sign because, the misses or when they come in weaker or lower. It's no different than the consumer, though, is got low expectations. So if actually you get tax relief, the consumer might surprise on the upside.
Reminds me a bit of quantum physics. The observer is entangled irrevocably with the actual phenomenon, but we better not get bogged down on that.
But Andy, that's the consistency of investing in stocks is investor behavior. That's the only thing that's consistent is how investors react. If you wind the clock back to October 2022, we had a 25% decline. What a great time to buy stocks. People didn't buy in 2023, they sold. The conflict of investing is stocks care about what's going to happen in the future, but we all look in the past to frame our viewpoints. So, right now the past looks pretty good, so people are pretty optimistic, but stocks are high. In 2023, the past was bad, stocks were low, but the past was bad, so people were more pessimistic.
So we have an S&P, let's say it's at 7,000 right now. It's very close to that. Where do you guys roughly see it ending the year?
Well, I think earnings will surprise on the upside, but I don't think you're going to get any multiple expansion. And so, I think you could see a 10% return this year. It's not going to be as good as the last, 3 years. That's again the consistency of later cycle when investors get more optimistic, return scenarios come down.
When you say later cycle, you can always debate whether the market moves in cycles or not. Maybe we could put up a 20-year chart for the S&P 500.
Sure.
But what kind of a cycle are you talking about here? Are we nearing the end of the U.S. economic rally? Is there going to inevitably be a slowdown, for example?
All I'm saying is, Andy, normally you get the bull market cycle lasts, not always, but somewhere around 5 to 7 years, and then you get a bear market, and bear market's a 20% or more correction. We came close last year, but not quite. So late cycle, what happens is investors get more optimistic, and so something comes along and the economy turns down, and it causes a substantial correction. I don't think it will be this year, but I am concerned with all this liquidity coming, with the Fed cutting rates, with tax relief coming. Could this be inflationary down the road? And then could the Fed have to pivot? And if you look at, the last 11 bear markets, most of them, over half of them are caused by higher inflation, the Fed having to pivot and raise rates. So I think that's the biggest risk out there. I'm not sure it's this year, but ultimately that's what causes the end of cycles. And you have a bear market and then you start over again. And we'll start over and I'll be on at some point, Andy, going, the market's down 20%. It's time to buy. People, oh, no, there's a lot of things to worry about.
The midterm, the elections coming up, always lots of heat and noise, sound and fury. What generally happens to the stock market in a midterm election year?
Yeah, I mean, it doesn't mean the market goes down, but it means it's not as good a year and you get more volatility. Now, the reason for that is very simple. The sitting president, doesn't matter, Republican, Democrat, wants to have their party win the midterm. So they roll out a lot of populist kind of policies to win votes. And that unnerves the stock market, unnerves investors. And you get, pullbacks. And look what's happened this year. We're already talking about capping credit card rates and a little bit more vocal against the big banks. I mean, these are very populist kind of moves. And, that's normally what you see in the second year.
Andrew, thank you very much. Always great hearing from you.
All the best, Andy.
Andrew Sliman, Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management. Coming up, the race to replace Canada's aging fleet of submarines. One South Korean firm is promising industrial benefits for this country if it wins the contract. South Korea's Hanwha may sail a submarine across the Pacific this spring as competition intensifies to land Canada's submarine contract. CTV's Judy Trin filed this report.
A deep dive into what could be the biggest defense procurement in Canada's history, the purchase of up to 12 submarines.
Because this has now evolved into a government-to-government situation. It's a big, big procurement. This is going to be a relationship with the winner for years, decades to come.
To persuade, the South Korean Navy plans to sail the KSS-3 submarine across the Pacific and dock in British Columbia, a journey that will take 2 months.
Your hands up here.
Okay. CTV News also got to see Hanwha's pitch up close. We couldn't film because of security protocols, but the attack submarine holds about 50 sailors. It launches vertical missiles that target land and has torpedoes. But the deciding factor will rest on economic benefits. To win the contract, Hanwha is pledging to help hard-hit businesses, like investing $345 million in Algoma to buy its steel and help it build a plant to make beams.
It's been tough as tariffs have been in place for a year and half of our business has gone away.
While some companies are hurting, others are looking for ways to expand. Using robotic technology, Hanwha builds 45 ships annually on its assembly line. Speed, Ontario's shipyards want to emulate.
I mean, what they do here is cutting edge. It's absolutely fantastic. If we can bring just a fraction of that to Canada, I think us as a country would be a lot further ahead in our shipbuilding endeavors.
The deadline for Hanwha and TKMS to submit their bids is March 2nd. It's a deal that could be worth $100 billion spread over more than 3 decades. It's investment that Canada needs to protect itself from Donald Trump's trade war.
Judy Trin, our colleague at CTV News. Coming up, about 3/4 of S&P 500 companies have beat profit expectations this quarter. So that's solid. It's actually a little bit below the historic norm. We'll get into that when we come back. So we're about a third of the way through U.S. earnings season. So let's zoom out and look at the big picture. Our guest specializes in U.S. equities and says early results suggest a market that's resilient but increasingly demanding. Investors want strong performance. We're joined by Christine Short, Head of Research and Global Corporate Events at TMX Data Links. Christine, it's great to see you. And so you work for TMX Group, our stock exchange company, but your focus here is U.S. stocks?
That's correct. I cover U.S. equities from New York.
Thank you very much indeed for joining us. So the pattern is we've seen the vast majority of U.S. companies so far this earnings season beating expectations, but it's actually a little behind the historical average.
Yeah, as you know, there's this earnings game where analysts ratchet down estimates heading into the season, guided by companies themselves, and then we tend to have close to 80% of S&P 500 companies beating on bottom line estimates. This quarter, we're at about 75%, so that's running a little lighter than the 1, 5, and 10-year averages. However, I'd like to note that coming into the season, instead of ratcheting down, the sell side actually bumped up estimates by about 0.5 percentage point. So these companies have a higher bar to surpass, and so it makes sense that, not all of them are beating as much as we'd usually like to see. The 75% of those that have beaten, they are beating by a margin of about 9%, and that's actually running higher than the historical average. So again, I think some would characterize this earnings season as being a little lackluster because of those beat rates being lower than we've seen historically. But if you look at, by how much they're beating, we're doing quite well. And right now, year-over-year growth is at about 12%. So the 5th consecutive quarter that we've seen double-digit growth for S&P 500 profits, which is, nothing to sneeze at.
And IT hanging in there, and communications services among the groups showing strong increases in profit?
Yeah, those are the two leading sectors, both on the top and the bottom line. Right now, you've got IT up almost 30% year over year as far as EPS growth concerned. You've got them beating up 20% on revenues. And then similarly, you've got communication services, like you said, up about 10% on both top and bottom line. The only real laggards we're seeing this season are consumer discretionary, energy, of course, healthcare, expecting negative year-over-year growth, but we got some great results from Pfizer and Merck today, so that might bump up a little bit. But we're about to get into more of these earnings, specifically on the consumer front. So we'll see if consumer discretionary can get out of the red as well.
So, yeah, we are watching out for Uber, Chipotle, and Yum brands. And, of course, we do hear consumer confidence in America is not that high, and lower income groups have been hurt, even though tax cuts are coming.
Yeah, that's true. But if you look at some of the companies that have already reported that rely on the consumer, like Starbucks last week, they actually said they're not seeing what's been reported in consumer sentiment surveys. They are seeing traffic increase, that consumer selling behavior isn't necessarily matching what consumers are saying. They're still seeing traffic. So we'll see if that's true for Chipotle, for Uber, some of those other, companies that are reliant on consumer behavior. Obviously, the jobs picture makes a huge difference in how much folks are willing to spend. We were meant to get the January jobs report on Friday because of the partial government shutdown. Now the Bureau of Labor Statistics says that will not come out. But, jobs have been hanging in there. The consumer has been pretty resilient considering all of the headwinds.
What should people watch out for when Alphabet and Amazon report?
That'll be the big round out of the Mag 7, right?
Yeah.
So we had some mixed results last week, as you know. On one end, you had Microsoft beating on the top and the bottom line, but with Q4 CapEx of $37.5 billion, that's the most in the company's history. That kind of spooked investors a little bit, right? Because Azure growth for their cloud product was only up 39%, and that fell short of analyst expectations. So as you started the segment, investors want to see perfect or better than perfect. So you can't miss analyst expectations and report, CapEx spending that's the highest in your company's history. So we're going to be looking out for those same numbers with Alphabet and Amazon this week. What do the CapEx numbers look like? With Amazon, it's rumored to be maybe about $150 billion for 2026. We'll see what investors think about that. If the growth is there to justify it, investors will reward it. We'll be looking at AWS numbers, obviously the leader in cloud providers, but both Microsoft and Alphabet have been gaining steam there against AWS. For Alphabet, it's again going to be about Google Cloud, ad revs, all of the search, so all of these areas that have been boosted by AI spending.
Just finally, it's an interesting piece of research here. Apparently, when companies postpone their reporting date, investors sometimes say, oh, that's not a great sign. They're trying to get their ducks in the row. Or if companies report outside their normal reporting period. For example, we just got Walt Disney numbers, and investors weren't delighted with those. So, and they reported outside the normal date range, I believe.
Yeah, you're talking about our LEARI, our proprietary metric, the Late Earnings Report Index, which actually came in with its lowest reading than we've seen in some time, meaning that CEOs were quite confident coming into the earnings season. They weren't delaying as much. But as you point out, there are still some big names like Disney. I think they only delayed by a couple of days. But when you have these major large cap companies that report on the same day of the week, the same week of the year, and they move it, you do question what IR was meaning to do with that. Are they trying to create a better story? Are they trying to take a look at the accounting a little further? So it does force you to look at the reports a little more. And as you said, investors weren't too happy with that report. So we do track that. But for the last few quarters, CEOs have been quite confident with those numbers. But we can see, there are some very large cap names that are delaying earnings report. And, I won't say that there is academic research that says when a company delays that it's highly correlated with bad news being shared on the report. But it really does reckon a closer look at the very least.
Christine, thank you very much indeed for joining us.
Thank you so much for having me.
Christine Short, Head of Research and Global Corporate Events at TMX Data Links. Up next, the latest headlines on markets. We'll check back in on shares in Palantir. We'll be joined by Jonathan Corpina of Meridian Equity. Welcome to the second hour of The Open. Let's get to those big stories we're working on in our newsroom. Canada's Financial Consumer Agency has fined the Bank of Montreal $4 million for overcharging customers. And that's after it failed to properly disclose fee details. Those penalties relate to discounted bank accounts for newcomers to Canada, medical and dental students, and Indigenous clients. The watchdog says more than 100,000 customers were affected between 2010 and 2024. CP Kansas City set a new record for shipping Canadian grain and grain products in January, both by amount and carload. The rail company says an effective crop year, winter planning, and demand forecasting helped it prepare for the month. Last week, CPKC also posted a record high in fourth quarter grain revenue, driven by a bumper crop. Shares in PayPal are taking a hit. This financial tech company says the chief executive officer, Alex Chriss, will be replaced after his turnaround plan failed to meet targets and streamline the payments business. He will be replaced by HP CEO Enrique Lores. PayPal posted profit and revenue in its latest quarter that missed estimates, citing weakness in U.S. retail spending and international headwinds. The TSX broadly higher in early trading, up around 1%. We are, though, seeing fresh selling in a bunch of traditional software names. Maybe we could have a quick look at CSU, Constellation Software, today hitting a new multi-year low. Descartes Systems down sharply as well. That's DSG, CGI, GIB.A, and OpenText, all hitting their lowest in at least a year. Now, I'm not sure if that relates to Anthropic announcing analytic software that will, for example, help filter through legal deals looking for unpleasant clauses. And let's have a look at the US markets. They have been buoyed today, generally speaking, by strong numbers from Palantir, but you can see the S&P 500 now slipping. Oh, yeah, and the NASDAQ down. So I was a bit out of date there. We did earlier get into record territory for the S&P 500, 6,979, but we are below that level now. Just looking at the big traders south of the border by value. SanDisk is up. People love those memory stocks. Palantir up 6%, but Nvidia slipping a bit. Micron down, Microsoft down, and PayPal sliding almost 20%, as just mentioned. So North American markets opened higher today, but then we saw weakness in the stock. Let's focus first, though, on Palantir, the vendor of software. In an interview with CNBC, Palantir called the latest results indisputably the best results I'm aware of in tech in the last decade. So no hyperbole there. Our guest says this headline should lift the markets, but cautions that we all know how quickly things can change. Joining us now is Jonathan Corpina, Senior Managing Partner at Meridian Equity Partners. Thanks very much for joining us, Jonathan. I'm not sure. I mean, it's a moving target, but what caused the market, do you think, to weaken after a higher open?
Yeah, I wrote that note last night, and how true it seems now, because we came into today off the Palantir earnings reports, off the trading activity that we saw yesterday, clearly an up market yesterday, and thinking Palantir was going to continue to help our markets overnight, in which it did. S&P futures were up this morning. As soon as the market opened today, we had some Fed comments coming out just about how the uncertainty of our economy is, and our data, our unemployment numbers, what they're going to look like moving forward. And very quickly, you can see that this market has changed direction. That doesn't change the earnings reports that we got last night, the sentiment from yesterday, the reports from today. It just kind of proves my point, how quickly this market can change off of one headline. And to me, that tells me one thing, that we probably are getting very toppy at this point. The market is soft, it's fragile, and one headline can shift this market in either direction, whether it's magnified to the upside or the downside. Yes, obviously we like to see it to the upside, but sometimes those movements aren't really warranted based off of those headlines. So again, today, couple comments coming out of Washington. They put a little bit of pressure on our markets in this early session so far. We'll see how the day plays out.
Palantir is such an interesting story, isn't it? It was down as of today this year, still up about 75% in the past year, now up almost 90%. Back in November, the Wall Street Journal said no company in the S&P 500 had hit a $490 billion valuation as quickly and with as little in sales. So it's got a famous multiple.
Yeah, I mean, great story that we have here. Clearly, I've seen a lot of volatility in that stock. There have been a lot of naysayers on the street about Palantir. So I think Karp's got a little bit of a chip on his shoulder to prove everybody wrong. Coming off the highs towards the third, fourth quarter of last year, trading around 200, and now it's come down, bouncing off the 150 levels, and we see where it's trading here today. Still has some room in front of it, but I think overall the story, the earnings reports, there is some wind behind it now. It's just a question of, does it have enough wind to get back to those levels that we saw at the end of 2025? This story continues to unfold. This is quite a hot area of investing, and I think when we start to see an earnings report like we did last night with Palantir, it should get some momentum behind it.
You're looking ahead to some classic consumer stocks, earnings from them, PepsiCo and Pfizer. What should we keep an eye out for here?
Yeah, we saw those this morning. Clearly some wins that we get there out of those two names. Uncertainty in the future is still going to be one of the forecasting headlines that we see in Pepsi. Trying to invest in different areas. Pepsi announcing this morning how well some of their soda sales are doing, but their snacks sales not as well. They're going to be lowering prices there. I think investors are seeing taking that as a as a negative sign. And in Pfizer, rightfully so, they've announced and we're seeing slowdown in some of the COVID product sales that are there, and they're seeing slowdown in some of the areas of older drugs that they have. But getting into that, continuing to move into that obesity business and investing heavily into that area there is a positive taken away from the Pfizer results.
And they are cutting prices on Doritos and Lay's chips. But of course, when I look at bags of chips in the supermarket, I'm not necessarily talking about those brands. They seem to get smaller and smaller. But in any case, they are cutting prices. What should we look out for with the forthcoming earnings from big tech? I mean, I know this theme of high spending, massive spending on AI capabilities will be a theme.
Yeah, we're still going to look for that headline. We're still going to see that headline that's out there. Kind of a unique area now, right? Because just the cash on hand that these companies have, the urge for investing internally, the urge for buying other companies clearly is going to be there. Yet we're still going to hear the story of uncertainty in the economic future as we continue to talk about interest rates. We're going to continue to hear about tariffs and the implications of that, tag on a few geopolitical risks that are out there. So I think from the headlines that we're going to see in these earnings reports coming out, net positive, yet they'll use some of these uncertainties out there to kind of manage expectations. And that's part of their job, is to really deliver a good story, yet manage the expectations of 1 or 2 quarters ahead.
Jonathan, as ever, thank you very much indeed.
Have a great day. Thank you.
Jonathan Corpina, Senior Managing Partner at Meridian Equity Partners. Coming up, a new report indicates that the Canadian economy is currently on life support. We'll hear from David Rosenberg after the break. A new report from Rosenberg Research says that the Canadian economy is on life support and that the economy probably shrank in 2 of the past 3 quarters. And we are on a clear recession watch for 2026. Let's get more from David Rosenberg, founder and president of Rosenberg Research. David, thanks very much indeed for joining us.
Great being with you, Andy.
The Bank of Canada has brought down interest rates by almost 3 full percentage points since 2024, but you reckon more is needed?
Well, the proof of the pudding is always in the eating. So, the bank has cut the policy rate by 275 basis points. Of course, the only people that borrow at the overnight rate are the banks. And nobody borrows at that rate, and other interest rates haven't fallen nearly as much. When I see the proof of the pudding's in the eating, question is, since the Bank of Canada started cutting interest rates in the spring of 2024, what's the Canadian economy done over this time span? And it's barely better than a 1% annualized growth performance. And although the population trends have slowed with the immigration rule changes, real per capita GDP in Canada is still declining. That has not been arrested. So, I would completely agree that the Bank of Canada probably never should have gone to 5% to begin with. So we came off rates that were very elevated. But it's clear to me, unless the policy lags are just a lot longer this time around, that if this is what 275 basis points of Bank of Canada rate cuts delivers, the grand total of a 1% growth economy, the next question is that all you get?
This kind of reminds me of the interest rate policy in the wake of the 2007, 2008 banking crisis. Low interest rates didn't seem to stimulate growth then at all.
Well, it's, Tiff Macklem wasn't wrong that a lot of the, call it structural issues with the economy are developments that transcend the power of the central bank. But at the same time, if I were in Ottawa and I were in his shoes, I would be doing all I possibly can. Inflation in this country is not really an issue. Virtually every underlying inflation measure is comfortably within the Bank of Canada's comfort zone. And the economy is growing below potential. And the Bank of Canada's own forecast, when you dig through the details, is for this disinflationary output gap to be with us, not just this year, but through the end of 2027. So I'm a little surprised that the Bank of Canada is taking such a strident approach. I do think that they will be compelled to cut rates further, even from this egregiously low interest rate. And I think the Canadian dollar, which I had been bullish on tactically, is going to come under some renewed downward pressure at the same time, because there's a case to be made that the Fed probably doesn't do anything at all, at least through the first half of the year.
We have a chart from you guys just showing real GDP year-over-year percent change going back to 2022, and it shows a relentless decline.
Yeah, we're running
in growth, I should say. Sorry, go on. Sorry, David. Yes, go ahead.
Oh yeah, we got the monthly data late last week. The GDP trend is running at roughly 1%. The fourth quarter sequentially, as you mentioned in your preliminary remarks, is probably going to be fractionally negative. And I'm trying to look around for what the source of vitality is going to be. I'm really quite surprised that most Bay Street economists have an inflation view, or at least some of them do, and that everything's going to be fine and dandy because we're going to get a modest amount of fiscal stimulus. I think this is still very largely a show-me situation. I'm looking at just a broad array of indicators, and it's quite striking. You would think that of all the sectors that would benefit from what the Bank of Canada has done, you think would be the housing sector. But if you look over the past year, residential construction expenditures are flat as a beaver tail. Home prices, everybody was telling me back in the summer of 2024, when the Bank of Canada started to cut interest rates, people were saying to me, oh, just wait, they're going to reignite renewed rounds of housing inflation. None of that has happened. In fact, home prices in Canada nationwide have either been flat or negative sequentially for 10 months in a row and are running negative 2% year over year. And then, we were hoping up until recently that there was some sort of detente with Donald Trump, that his relations with Mark Carney were starting to improve. Well, of course, we can throw that in the waste paper basket right now. But, you're taking a look at manufacturing activity in Canada, even with what would be deemed a competitive exchange rate and red-hot U.S. economic growth that you'd think would be pulling in Canadian shipments. Manufacturing is actually down 5% year over year. Like, you're talking about a recession. Well, you have a recession already in the manufacturing sector. And there's no real thrust in terms of retail sales. When you adjust for whatever inflation there is at the retail level, there's practically no growth there either. And that, of course, is very interest sensitive. So it comes back down to, your view on the Canadian dollar is basically if manufacturing and exports, it's incredible. Exports are lower today, the level of exports, than they were in the spring of 2022. And they're also running negative year on year. Manufacturing, I'd mentioned, and industrial production running negative year on year. That's telling you that as weak as the Canadian dollar has been up until recently, it's probably not weak enough. You want to be bullish on the Canadian dollar, you have to start seeing real positive thrust in the areas of the economy that are most sensitive to the currency. It's just not happening. And that's a huge disappointment, especially to me, because I changed my call to a more bullish view on the loonie late last year. But the only reason why the Canadian dollar is off its lows, of course, it's retraced part of that, is only because of the broad-based debasement trade in the U.S. dollar. I'll tell you what Canadians should be measuring the Canadian dollar against is really against the Australian dollar and the New Zealand dollar. And it's not because we do a lot of trade with those countries, but those are our, commodity-oriented brethren. And the Canadian dollar, just in the past 2 months, is down more than 4% against both those currencies. What's that telling you? Well, it's telling you that they have higher interest rates because they have stronger internal demand. Of course, they're more hitched to Asia than they are to the United States, so they're hit less by all the trade uncertainty. And that's just the currency aspect. If you believe that the Bank of Canada should keep rates on hold, if you believe that interest rates are actually working, then you have to ask yourself the question, why are the most credit-sensitive sectors, primarily housing, residential construction, home prices, retail trade, why are they all basically either stagnating or declining? And that's telling me that as much as the BOC has done, they haven't done enough just yet.
David, before we let you go, we're tight for time. What about Ontario? Because it's kind of emerging as the sick man of Canada in economic terms. The Fraser Institute said in August, a while ago, that economic stagnation in this province means that we now, in Ontario, have a lower standard of living than the rest of Canada. Is that a big part of Canada's malaise, Ontario going nowhere?
Well, look, Ontario's the poster child for the deterioration in trade relations with the United States. There's no other province that has that sensitivity to manufacturing, which I said is in recession. And there's no other province that has such close economic ties with the United States. So that's really the big problem for the Ontario economy. We're not resource oriented. There's been obviously a bull market in most resource prices. Well, that's not what Ontario is about. Ontario is a manufacturing hub with tremendous export sensitivities to the United States, and that's why the province has been penalized.
We'd better jump, David, but your message to Tiff Macklem, start cutting again, or think about it strongly. David, thank you very much indeed for joining us. David Rosenberg,
thank you, Andy.
Founder and president of Rosenberg Research. Coming up, we are going to get a reading on where money is flowing in the ETF market. We'll be joined by Valerie Grimba of RBC. Time for the ETF report. Our guest says January was an extraordinary month for the ETF market, with almost $30 billion pouring in across a variety of asset classes and geographies. $27 billion in inflows. We're joined by Valerie Grimba, Director of Global ETF Strategy at RBC Capital Markets. Great to see you. I mean, thanks for joining us. January was a good month for stocks. And ETFs sucking up yet more capital.
Yes, thank you so much for having me, Andy. January was, again, nothing short of absolutely incredible. And at this point, I feel a bit like a broken record here. The boy who cried wolf, or potentially the girl who cried, and ETFs are going amazingly. But I do want to contextualize that almost $30 billion number. It's such an incredible record. Last year, the kind of monthly run rate, which we thought was impressive at the time, was about $10 billion. Every month into ETFs. So to hit $27 billion in the month that was January. So listen, yeah, generally it was risk on, but there's still a lot of volatility in the market. Macro conditions are very interesting and very uncertain as well. And January is also not typically a seasonally strong month for ETF inflows. So I think all of those things combined makes January even more impressive than just the headline number as well. And I think we can attribute that to multiple factors, but really it's kind of everything firing on all cylinders. So as you mentioned, it's all across all asset classes, across multiple geographies. And we're also seeing interest from all the different kind of investor segments. So sometimes ETF inflows can be driven by institutions putting very specific exposures on. But in January, it was institutions, it was retail DIY investors, and it was financial advisors. So really broad-based interest. And another fun fact about January is the incredible breadth. So over 2/3 of all Canadian listed ETFs saw inflows in January.
Just remind us, what does it mean when we say an ETF has inflows? What's the mechanism?
Yeah, that's a great point. So what we classify as an inflow is net new money going into the ETF. And we can measure that because we can kind of strip out the performance and understand the actual dollar figure that is going into an ETF. And so this is, for all intents and purposes, buying interest and new assets, new capital flowing into these ETFs.
I know you can't get into the full mechanics, but so an ETF, it's not like a regular stock. Say if I want to buy a US equity index ETF and I buy it on the market, am I not buying it directly from another investor?
Correct. That's the difference, is that if you're buying a stock, it's traded on the secondary market, and there is only a finite amount of shares available, unless the company, of course, issues more from the primary. But in the ETF world, the secondary market makers like RBC can interact with the asset managers, and so we can go out and we can create new ETFs. So that's really the beauty of the ETF vehicle, and that's also how we can measure the amount of buying interest and kind of clock this through fund flows. And it really gives us an excellent picture about investor trends, where they're placing their money. And we can see this on a daily basis, actually. So as we're kind of going through these volatile times, it's very interesting to get a gauge on sentiment through ETF flows and ETF interest.
I mean, one ETF that leaps to mind here is BMO MSCI Emerging Markets Index ETF. If we look, I'm just looking at a one-year chart. That one, we have it there. You can see that's been climbing, just to pick one example.
Yes, exactly. Emerging markets have been absolutely on fuego in January. They have seen incredible inflows. So again, that indicates to us incredibly strong buying happening on the market there. And I think that's been driven by two different factors. One, of course, is emerging markets have been very hot. They've had a very strong start to the year. You've had many LATAM countries that are up 15% or even 20% in the case of Colombia and Peru in January alone. So there is some investor performance chasing. They want to be a part of this trade. They want to get long that exposure. So they are buying emerging markets. But I think another facet here is that we're seeing investors broaden out their exposures. And I think that's really at the expense of the U.S. mega cap trade. And maybe investors are getting concerned about valuations or things just looking kind of fully baked in here. So they're looking for other alternatives in their portfolio and how to diversify away from U.S. exposure. And right now, emerging markets are performing extremely well. And we are seeing investors kind of follow into that trade.
Valerie, thank you very much indeed. Valerie Grimba, Director of Global ETF Strategy at RBC Capital Markets. Coming up, gold and silver bouncing back today after that brutal sell-off at the end of last week. We'll have more after the break. Okay, let's have another look at gold and silver. We saw signs of them regaining a bit of momentum today, but there was a brutal sell-off at the end of last week, and both are well below the record highs they hit. Let's get more from Jake Hanley, Chief Growth Officer and Director of Investments at Teucrium. Thanks very much indeed for joining us.
Thanks for having me, Andy.
And just to clear the decks, Teucrium, of course, you're known for copper, your copper ETF and other commodity-based ETFs, but you haven't got a gold and silver one yet.
No, that's true. And actually, we don't have a copper ETF.
Oh, I'm sorry.
No, that's quite all right. Well, I'm pretty bullish on copper, so I can understand the confusion. We are primarily in agriculture.
Oh, okay, sorry.
Corn, wheat, soybeans, and sugar. Yeah, but with copper, we do publish a commodities model portfolio, an allocation that we make available for anyone who'd like to receive an email from us, and we include the metals. And so we've been following these markets very closely.
Sorry, yeah, of course, you're known for Teucrium soybean fund, corn fund, sugar fund. You got the agricultural fund, and for some reason I thought you had a copper one. In any case, what have we learned about the gold and silver market over the past few weeks?
Oh, boy. Well, for anybody who was just getting involved in watching in the last few weeks, you've gone a crash course in speculation and volatility. I think what we've clearly seen with silver in particular is the crowd getting ahead of itself here. Prices got well ahead of fundamentals. And when you see a run up like that, there's this old saying that prices will continue to move higher until they don't. And boy, oh boy, when they stop, they can reverse quickly. And so the sell-off that we saw, some want to give it an adjective and say it was disorderly. I would say while the magnitude, it was a big sell-off, it was relatively orderly. And I say that because behind the scenes, you have a lot of structural risk programs that certainly were firing off to help institutional traders cover their positions to avoid what could have been contagion. And so while the sell-off was really big in silver, I think it was orderly. And I would just point to the fact that this really has been just for silver and gold markets, really hasn't bled over into equities, a little bit into copper. But because this was such a big sell-off, I was encouraged that the selling didn't bleed into broader markets.
Wall Street Journal highlights that it's relatively easy for retail investors to speculate in gold and silver, for example, using ETFs. We saw leveraged gold and silver ETFs, such as UGL and AGQ, posting massive turnover, and then they plunged by 60% in one case on Friday.
Yeah. And so, investors beware, make sure you understand the risks inherent, particularly with these leveraged products. A lot of them will track the daily performance and not a longer period. And so unless you're day trading those products, your experience will likely, be worse than what you would think. I will just note, I've been looking at the flows, and I heard the last segment you were talking about ETF flows. Interestingly enough, it appears that the 2X silver ETF had a record trading volume on Friday during that sell-off, and it looks like it was buying because the fund took more inflows on yesterday as it looks from the tape.
The narrative, you touched on this. I mean, it seems to be that speculators drove gold and silver. Obviously, it was a big part of it. The Wall Street Journal, again, argues that these things these days change quickly and investors jump onto the next shiny object.
Yeah, they do. But I would just put out there as well that there is a fundamental case for silver. There's a fundamental case for gold. There's a fundamental case for copper. And while the speculators certainly have the ability to add volatility that we've seen recently, the fundamental case is there. And I think it would be a mistake to ignore some of the longer term trends that we see developing in these markets. Again, if you're a day trader, if you're a speculator, if you're just following the momentum and following the trend, you're going to be in and out, and that's going to create volatility. But I do believe that when you zoom out and you look at a monthly chart, or if you just sit back and you're following along with what the fundamental supply-demand dynamics are in these markets, it's hard not to be bullish longer term. Now, there is certainly a bear case. They say that the trigger that set off the selling was the announcement of Kevin Warsh as the potential Fed chair. And so in my view, that's to be determined whether Mr. Warsh has what type of impact he has on gold and silver markets. But there's also, global GDP growth. If we see a slowdown in growth, that could act as a weight on markets because inflation expectations would go down. Copper demand would potentially go down. The AI bubble could pop, right? If the AI bubble pops, then maybe there's not as much copper demand. So there's certainly risks. But again, if your base case is for global GDP to, keep chugging around maybe that 3% level, and for the idea that the geopolitical situation does not seem to be improving in a positive way, I think things like copper and things like gold should continue to do well.
The old cliche, of course, is that an ounce of gold buys you a decent man's suit. So I'm trying to think, $5,000 US, that's a pretty good suit. I don't know, I'd call that pretty flashy. I mean, if you work at Goldman Sachs, maybe it's not fancy enough.
Yeah, well, to that point, you look very dapper, sir. And I go to the quarter zip sweaters these days because I don't have the 5,000 for a suit.
Yeah, oh no, you'll see me at the bargain rack. I ain't going there either. Thanks very much, Jake. I really appreciate it. Jake Hanley, Chief Growth Officer and Director of Investments at Chukria. Up next, hot picks in the restaurant sector. Let's talk restaurants and casual dining and coffee. Okay, so we're talking eating on Hot Picks today, and we're starting off with McDonald's. Our guest has that as a top selection. He expects it will post a strong fourth quarter by offering new menu items. We're joined by John Tower, equity research analyst at Citi. Thank you very much indeed for joining us.
Hey, thanks for having me, Andy. Hope you're doing well.
I am indeed. So I'm looking at McDonald's obviously a reliable blue chip for many investors. Stock up a total return of about 47% in the past 5 years, lagging the S&P 500 a bit. But you see promise here, in particular, a new emphasis on chicken. How will that help them?
Yeah, look, their chicken menu relative to the competitive set, I would argue, has been somewhat bland. You know, they introduced the spicy chicken sandwich a few years back. It worked out relatively well. This most recent year, 2025, they added chicken strips. You've seen it show up in their snack wraps. It's been an okay product. I don't think it's been the home run product that they were looking for. I think what you're going to see in 2026, perhaps later in the year versus earlier in the year, is more innovation around grilled chicken, probably an upgrade on even the strips that they have, potentially moving to some of the tenders. They did have those selects back in the day that worked out very well for them. And I think you're going to see more by way of flavor on the actual, toppings for the chicken. And look, in test markets across the U.S., they are testing wings. I don't know if that's going to make its way finally to the menu. We did see it back in 2013, I believe. It was an LTO, limited time offer. Could it come back? Maybe. I think actually more interestingly, they're getting more aggressive in beverage. And I would not be surprised on this earnings call, which will be coming up in about a week, if we hear more color on timing around potentially getting on a, more robust beverage platform. So think, expanded coffee platform, more importantly, refreshers and energy. That's likely something we'll see sometime earlier in 2026. When you could think about taking a step back about the company, prior to the past year and a half or 2 years or so, this company didn't really have its marketing and product innovation muscle in place the way that it does today. They had spent really from 2016 through the early parts of COVID working through the Experience of the Future remodels in the US. So they spent a lot of energy and capital on that, which was kind of refreshing the asset base. And it came at the expense of a lot of this product innovation and marketing, not to a massive degree, but to enough. And I think what's happened and what we're seeing, and even the message from the company in the past 12 months is, hey, we've found some mojo here. We're putting a lot more energy towards this. And we understand that getting new products at a higher velocity across the system with better messaging is going to drive more traffic to our stores. And that likely means you're going to see much more consistent same-store sales and traffic growth from the brand, particularly in the US, but even globally starting this year.
It's interesting on beverages. They might be going towards these so-called functional beverages or energy drinks. And because the margins on beverages tend to be huge, don't they?
Yeah, they're better than, say your chicken sandwich or so. I think operators, particularly franchisees, look at this from a penny profit standpoint. They can still make some pretty good penny profits off of these platforms. But I also think what it does for them is it opens up day parts where perhaps today they're either under indexing versus some of the competitive set, or, it adds a nice check lift to different parts of the day. Say breakfast, for example. If someone was coming in getting a hot coffee, now you've got potentially a more robust menu where you can upgrade $1 or $2 to get some of these cold beverages and energy drink. So it does widen out who they're speaking to and likely drives greater frequency to the business going forward.
Let's move on. Dutch Brothers, they have beaten the pants off Starbucks over the past 5 years, although I notice the stock is down from its high.
Yeah, so the stock's been under pressure year to date. I think there's a few things going on. In particular, it's been a name that a lot of folks like on the buy side and the sell side. I think that over ownership to start the year has been a bit to the stock's detriment. I do not believe that they're having weakness, particularly in their business outside of weather, like the whole industry is having. The other bigger fear, I think, that's been permeating throughout the marketplace has been around competition, right? We heard from Starbucks last week say that they're expanding some of their beverages, they're getting into energy. McDonald's, as we just spoke about, is getting more robust in the energy platform. But taking a step back, we can actually look in the marketplace as an example for what can transpire for smaller brands when they're positioned well, when a bigger entity comes in and starts marketing value. And that is, you look at McDonald's at that 2010, 2012 timeframe when they got more aggressive on coffee, premiumized it. It actually helped out Starbucks quite a bit in the US, who was growing like a weed at the time. I think that's what's going to happen here with Dutch Brothers. You'll see these other brands marketing it. And I think what consumers will do, particularly younger consumers, they're going to go back to the brands that they love and that they're being spoken to. And they're going to go to the brands that have customizable energy and a much more robust menu in a convenient fashion. And I think Dutch Brothers is going to ultimately benefit from this wave of competition coming into the category.
And just finally, we're tight for time. I'm sorry, but Chipotle Mexican Grill, that stock has been a disappointment for investors, but you see the prospects for a turnaround.
Yeah, I think 2026 is going to be a much better year for them. I think you're just going to see a greater velocity of new product news, traffic driving initiatives across the company. And frankly, there's a lot of fear on margins for the company in 2026. I think we're going to hear a better story from them. You know, tonight you're going to get relatively mixed news on the fourth quarter, and perhaps because of weather, weaker noise about the quarter to date, but I think they're going to be conservative on their guidance. It's going to be a very good year because you're going to see much more traffic coming back to their stores in the back of better product news and marketing.
John, thank you very much indeed. John Tower, equity research analyst at Citibank. Coming up, the U.S. is launching a $12 billion U.S. critical mineral stockpile. We are going to hear from a Canadian graphite player after this. Washington is launching a $12 billion U.S. critical mineral stockpile. The plan here is to help redirect major U.S. investment or major investment in critical minerals towards the USA specifically. But it could benefit North American producers generally. What does it mean for Canada? We are joined by Eric Desaulniers, CEO of Nouveau Monde Graphic. Eric, thanks very much for joining us. Before we talk about Nouveau Monde, but tell us, what do we know about this stockpile? For example, will it include graphite?
Yeah, thanks for having me, Andy. So it's a very great news. We learned yesterday, obviously, having a $12 billion customer adding up in the U.S. is quite attractive. We knew something was about to be announced in the U.S. We didn't know exactly what, but we believe it's a very smart move from the U.S. administration to make sure they build this stockpile. It only means critical minerals are at the center of national security. About defense readiness so we need to have our own sovereignty for industrial purposes, not only defense. So this is really what we learned yesterday. It's not a stockpile ready for defense. It's more for civilian application as well. So this is quite exciting to see this unfolding, considering our positioning in the G7 countries. Yeah.
Do you know for a fact whether it'll be in the new graphite itself will be one of the minerals in this stockpile?
Yeah, it wasn't specified yesterday, but it's obvious it will be. Like U.S. are importing 100% of their graphite demand. It's at the center of not only the battery market that we know very well. We are a supplier to Panasonic Energy in the U.S., but also a lot of defense contractor for very niche application needs the graphite. So not only in the concentrate form, but in transformed form as well. So quite exciting to see what will unfold, but we're quite confident graphite will be part of it because it's really a priority for the government of U.S.
It's interesting. Apparently, the University of Michigan and Ford Motor Company looked into this question of whether America could mine enough graphite for its needs. And it could, but it's going to be complicated. I guess the processing is a major factor.
Yeah, it's all about having the right geology to have the right cost point to start with. We have this. We have a low-cost deposit where we can produce at about $420 US per ton, a ton of concentrate. The equivalent in the US is not seen. Their deposits are difficult to mine, or either remote or metallurgy are difficult. And then you pointed out, it's the transformation. So you need to have low-cost electricity. We do have that. So we have all the chemicals, all the industrial complex nearby the deposit to transform it in active anode material. So for us, we're really well positioned to be the lowest cost producer and the largest operator of this active anode material in the G7 countries.
So just remind us, where is your deposit and where are you in terms of production?
So we are located, the mine itself was named last fall a project of national interest in Canada. The Canadian government do have an offtake as well, alongside an investment and a commitment for the debt as well. We're 2 hours north of Montreal, so that's where the mine is located. And we are scheduled now, should we do the final investment decision as expected in the first half of this year, we will be producing full-scale capacity second half of 2028. And then a quarter of the production is already planned to go in Bécancour. That's an industrial complex between Montreal and Quebec City to deliver the contract for Panasonic Energy, they have made 100% commitment for the production in Bécancour for the next 7 years. So that's and an investor in the project and in the company as well.
And then you've got another project nearby at Matawini, which will be a mine and a concentrator?
Yeah, exactly. That's the project 2 hours north of Montreal. That's the Matawini mine. This one, like we obtained all permits in 2021. We have all the IBAs with the First Nation. The community is on board. We have already allowing about over 50% of all the contracts to build the project. We're really advanced on this project, so you should hear more in the near future about the official launch of construction, hopefully.
So your market cap, according to Bloomberg, about $388 million. Now, the stock topped briefly $6 in October. It's since dropped to about $240. Why is it down from October? I mean, I know it was like a sharp run-up. What caused that spike?
There was a bit of volatility caused by mainly a lot of interest coming from the U.S. for critical minerals. So there's good days, bad days when stock is so volatile and attractive. But I think now it's back to a very interesting entry point for long only investor who want to really take advantage of the most ready project into this critical mineral that is obviously essential for our economy.
And can you give me a rough idea of how, we're looking at the stock here, thanks control room. Can you give me a rough idea of how much money you'll have to raise for the projects you have in hand now?
Yeah, the capex for the Matawini mine is $421 million, based on the last feasibility study we filed in November last year. So very current, very recent. And as I've mentioned, we have aligned half of the capex contracts already, so pretty confident on this. And for the active anode material plant, we have found a brownfield facility to accelerate the schedule, reduce capex intensity, and we're trending around $213 million US to deliver the Panasonic contract. So very optimized version of what we had previously. Obviously, greenfield project are always come with their risks. So now having a brownfield facility to deliver this active anode material plant as fast as possible with lowest cost of construction possible was a very, very interesting for us and our shareholder.
Thank you very much, Eric. I really appreciate it.
Fantastic. Thanks,
Eric Desaulniers is CEO of Nouveau Monde Graphite. We're out of time on the open. Morning Markets is up next.